afternoon, everyone. This is Charlotte Hill, who leads the Financial Services Regulation practice at Taylor Wessing. We've got a good lineup for you this afternoon. Please forgive the late start. We had quite severe technical difficulties in getting this set up and starting it. We've got some new equipment here. But we've got quite a nice lineup for you. We've got a potpourri of things to talk to you about, of various things. 6 items. You can ask questions during the webinar. We'll either answer them during the webinar, or we will get back to you later. There should be a questions button at the bottom of your screen. So we will give you an update on Brexit, which Daniel will do. I'm going to speak to you about an FCA research note, Cryptoasset consumer research, some research that the FCA did, which had actually some very interesting results. There'll be a COVID-19 update from Daniel. I'm going to talk to you about a paper on from the Climate Financial Risk Forum. Daniel will talk about the Prudential regulation of MiFID investment firms. And finally, I'm going to talk to you about a paper about artificial intelligence. So on that, I will hand over to Daniel to give you the Brexit update.
Thank you very much, Charlotte, and good afternoon, everybody. So a topic which used to be very much in the news was Brexit, and it's back in the news because it is not long to go until the expiry of the transition period, which expires on the 31st of December 2020. And so we thought it would be useful just to update you on a few matters regarding Brexit. And we thought we'd do this through the lens of the FCA and the government and the Treasury in particular. So there was a speech on the 1st of July 2020 by Nausicaa Delphus, the Executive Director for International at the FCA, entitled Building a Financial Regulatory System Suitable for the UK in the New Era. And Nausicaa Delphus, in the speech, identified Brexit as being one of the defining developments of the new era, alongside COVID-19 and technological and societal changes. The message should by now be very clear, which is that we all need to prepare for a range of scenarios. And from our contact with clients, this is the approach that most of them have been taking, which is to plan for the different types of scenarios that could occur. What's been going on? Well, there's been a process of onshoring EU law to the UK statute book. That means bringing all the various pieces of EU legislation into the UK legal framework and reflecting where necessary changes in the FCA rulebook. We've seen the use of the temporary transitional power, a government scheme given to the regulators, enabling them to adjust the application of rules. And what this means is that there will in fact be a temporary period post the transition when firms can continue on the basis of the regime that was in place at the end of this year for a limited period of time. We also have seen the temporary permissions regime, which enables incoming EEA firms to continue, for example, to market funds in the UK. That will be reopened in September 2020. There will also be an opportunity to make amendments to existing notifications. So far, over 1,000 firms and over 600 fund managers have notified the FCA. From the beginning of next year, EEA firms will have to apply for permanent authorization to replace their temporary permission. Another government scheme is the financial services contracts regime. This will allow EEA firms to continue to service contracts which are in runoff. The FCA has been extremely busy. It has entered into a number of MOUs, memoranda of understanding with EU and non-EU authorities to enhance supervisory cooperation. It's been providing assistance to HMT on equivalence assessments and government on trade negotiations. We'll come back to equivalence assessments in a bit. And it's the outcome of those equivalence decisions and trade negotiations which will impact some of the post-transition risks. So, for example, risks of disruption from overlapping share or derivative trading obligations. At the same time that the UK created the temporary permission regime, we saw a number of other member states of the EU coming up with reciprocal arrangements, certainly not a consistent approach, but we did see particular member states coming up with arrangements which would allow UK firms to continue to service customers in Europe. Now, a very important point which was made in the speech is that those temporary regimes in member states may have lapsed. They may actually have changed significantly. So businesses really do need to adapt their operations to comply with local law and regulations. They should engage with local regulators where that's required. They may need to obtain permissions. Contracts may need to be repapered. And of course, customers must be treated fairly throughout this process. So, looking ahead, after the end of the transition period, well, the FCA is going to be guided by a continued commitment to the highest international standards, and this is reflected in the UK's input into the IOSCO report on good practices on processes for deference, which was published in June of this year. The FCA will look at what is right for the UK's markets, building on the strengths of the existing UK regulatory and legal system. A very important part of the shape of regulation post 31st December 2020 will be the output of something called the Financial Services Future Regulatory Framework. This was initiated by the previous Conservative administration, and this is going to look at how the various key players in financial services will work together. So, what is the role of Parliament, of the Treasury, of the FCA, the PRA, the Financial Policy Committee, the Payment Systems Regulator, and the main stakeholders? We have a current situation where policy legislative functions, key functions, are undertaken by EU institutions. Well, they're going to have to be taken by UK institutions. How will policy be translated into regulatory rules? How will functions be made accountable? We'll come on later in this presentation to talk about the approach to the regulation of MiFID investment firms, because that's somewhat indicative of the approach which may be taken. The FCA has been busy providing technical advice and support to the government as it considers future trade opportunities. This is highlighted in the bilateral financial services agreement between the UK and Switzerland, and it is also very much continuing to engage internationally, and the upcoming UK-Singapore financial dialogue is noteworthy in this respect. Well, changing the lens from the FCA to the government, there was a very useful set of submissions by HMT to a committee, House of Lords Committee, and they spoke further about the future regulatory framework. HMT intends to consult in the autumn of 2020. The consultation will cover how regulators should operate in dealing with technical standards and what type of scrutiny will be put in place to examine the innovation of policy innovation from government and how that interacts with regulators' responsibilities. The Financial Services Bill is due to be published this autumn. That will look at the overseas funds regime, market access to the UK for Gibraltarian financial institutions, and will give the government power to implement prudential measures for banking and investment sectors based on international and EU measures. And we will talk a little bit about the EU measures for the investment sector a bit later. Equivalence assessments has been in the news a lot. There are some 40 equivalence provisions across 17 pieces of EU legislation, and the political declaration between the UK and the EU contained a commitment to complete the assessment by June of this year. Now, the UK has completed the assessment of the EU. The EU has sent the UK 1,000 pages of questionnaires, which contrasts with the UK's 1.5 pages. And the UK has indicated that it is has worked through most of these and is intending to complete these soon. But this has in fact attracted a lot of attention and some difficult exchange of words between the EU and the UK. We put on this slide some useful links, some of the statements which have come out from the Commission, what are called prepared notices for different sectors. They lay out quite clearly the position of the UK as a third country come the 1st of January 2021 with the loss of passporting rights and what all of that means and how will this impact firms that are delegating and so on. FCA has a number of pages of use, so does the Bank of England. Without further ado, having talked about Brexit, we will now move on to crypto assets. Charlotte.
Thank you, Daniel. I'm going to be talking about the FCA's research note on crypto asset consumer research, which has just come out just a few weeks ago. It's something that's come out building on prior work by the FCA. A joint report was published in October 2018 from the FCA, the Bank of England and the government, which was part of the UK Domestic Task Force on Crypto Assets. In that, the FCA and the other participants provided an overview of the state of the UK crypto assets market, and they also, at that time, committed to carry out several actions. The task force report identified 3 major risks of harm which were associated with crypto assets. So that's harm to market integrity, the risk of financial crime, and also the risk to consumers. But at that time, they also acknowledged that there was a very limited amount of detailed or credible evidence on that market, and so they wanted to do something about that. So they commissioned research to gain insight into the size of the market and to identify any potential harm. So that led to some consumer research which was published by the FCA in March 2019. That was research into what was called, what they said, consumer attitudes and awareness of crypto assets. They had a nationally representative survey of 2,132 UK consumers and carried out 31 in-depth interviews. And that provided insights into the size of the market and where the potential harms might be. And the result of that was that the market was actually very small. Only 3% of consumers had ever bought crypto assets, and the average spend was £200. And it also showed that the general awareness of crypto assets amongst the general population was actually very low. They thought that information was very informative, and they thought that they'd learned a lot from that about attitudes and motivations and what people actually thought about crypto assets. But aspects of the research were really rather limited. So was limited because it was really very, very small. The research was exploratory, and it reached a sample of only 31. The National Representative Survey started with 2,132 participants, as I say, but the specific follow-up questions related to cryptocurrency ownership were only applicable to a small subset of only 51 adults, as the remaining individuals in the overall study population had never purchased crypto assets. So they decided to carry out some more follow-up quantitative research with a much larger sample of crypto asset owners to allow for greater accuracy, and also to allow the FCA to see how the market had changed over the past year. The research was conducted online by YouGov, and 2,681 participants were questioned. So from that, we got some key findings. So I'll run through those. I think they're quite interesting. So 2.6 million consumers in the UK have bought crypto assets at some point. That represents a 1.1 million increase since last year's survey. Of the 1.9 million that hold crypto assets, so that could be Bitcoin, Ripple, or Ether, half have more than £260. That amounts to 3.86% of the general population owning cryptocurrencies, and to come up with those figures, the FCA reckoned that the population of the UK was round about 50 million. 75% of people owning them own under £1,000, so although there's quite a few people owning cryptocurrencies, they don't have very much money invested in them. A surprising result, I think, is that the technical knowledge was actually very high amongst owners of crypto assets. They were very knowledgeable about the product, they're aware of the lack of regulatory protections, they understand what price volatility is and what the risk is involved in that, and they also have a good knowledge of the underlying technology. But against that, a lot of people knowing a lot about it, there were also quite a lot who didn't. Around 300,000 crypto asset owners believed that they did have regulatory protections. That's around 11% of people, which the FCA concluded represents a risk of consumer harm that they ought to be taking some action about. So this year they found that 27% of people had never heard of cryptocurrencies, but last year they found 58% of people had never heard of cryptocurrencies. So there's been a huge increase there, an increase from 42% to 73% of adults. They also looked at why people bought cryptocurrencies, and the main reason for doing that was, well, it's a bit of a gamble, and it might make some money or it might lose some money, which also reflects why people don't actually invest a huge amount in it. For example, one woman who was interviewed said, and I'll quote this, "It's much more volatile and less reliable than other investments. It's more of an exploration and it's a bit of fun." So that quote sort of really reflects the reason people do tend to, both men and women, why they tend to invest in buy crypto assets. They also had a look at whether people actually used them, and they found 47% of people had actually never used them. 27% had used them to purchase goods or services. 25% had used them for exchanging for other cryptocurrencies, and 12% had used them to purchase other financial products. So almost half of people had actually bought these and had actually never used them for any purpose at all. Cryptocurrency exchanges are a key market participant, and they found that most consumers used non-UK based exchanges. So yes, they used exchanges based overseas. That's 83% of consumers. Interestingly, and this really has influenced what they're going to be doing next, they found that advertisements play a very key role in influencing the decision to purchase crypto assets. And more than a third of people said that they'd bought their crypto assets because they'd seen an advertisement for them. They found that various sorts of advertisements in various sorts of media were influencing them. It wasn't just online things, it was newspapers, magazines, journals, whatever. But advertisements were very high on the list of influencing purchasing decisions. 45% of people said they'd seen a cryptocurrency-related advertisement and had responded to it, and 35% said that the way the advertisement was phrased and what it advertised made them more likely to purchase. Another interesting thing, they looked at the gender of people owning cryptocurrencies. 79% of cryptocurrency owners are male. 69% are over 35. So that's quite interesting, because I'd have thought it would have been on the younger side of people owning it, but most people are more mature people, over 35, and by far and away the majority of people owning crypto assets are male. Various next steps. The FCA is reacting to what it found. In the last budget, the government said that it intends to consult on measures to bring crypto assets into the scope of the financial promotions regime, so responding to the fact that people respond to advertisements when purchasing them. The FCA is working with the government and the Bank of England as part of the UK Crypto Assets Task Force to understand and address what harm can arise from crypto assets, whilst also not wanting to stifle innovation either. We're going to get a policy statement later on this year, but that follows up the consultation on banning the sale of crypto assets derivatives to retail investors. And now back over to Daniel for the COVID-19 update.
Thank you very much, Charlotte. I sometimes feel that updates on COVID-19 are almost business as usual, and there have been a number of regulatory developments on COVID-19 since we last spoke to you, and we thought we would just highlight some of the most important ones. So at the end of June, the FCA set out its expectations for approved persons regime. The approved persons regime, as you know, is largely no longer applicable to most of the financial services industry because the SMCR applies. But there are still small groups to whom it applies, namely appointed representatives and benchmark administrators. So the FCA has set out its expectations to help those two groups during the COVID-19 crisis. The first thing that it has done, it has taken the same approach as it did with solo regulated SMCR firms as regards temporary arrangements. So some benchmark administrators and appointed representatives have had to make temporary arrangements to cover absences because of the pandemic. What the FCA is doing is allowing firms to extend the 12-week rule, which is the default period during which a temporary arrangement can be made without approval needed, to extend that so the period can last for up to 36 weeks. So 12 weeks to 36 weeks. The principal must notify the FCA rather than the appointed representative. This may be obtained on a cautionary basis. Important to note that customer function CF30 roles cannot be covered using the 12-week rule. For benchmark administrators, the application of this particular modification is more restricted as they will become subject to the SMCR on the 7th of December 2020. Furloughed staff, well, we know that there are instances in which firms have had to furlough their staff in the financial services sector, and the FCA has again taken the same approach as it did for the SMCR regime by saying that furloughed staff will retain their approval and will not need to be reapproved on their return. Benchmark administrators or the principal of the appointed representative remains responsible for ensuring the approved person is fit and proper. So what about notification and documentation? Well, again, the FCA has said that it doesn't expect firms to notify it of temporary arrangements caused by COVID-19 using Form D, but that those arrangements must be clearly documented internally and be available on request by the regulator. Internal records should provide a running commentary of significant function holders and their responsibilities. Principals should ensure their appointed representatives do the same. So in giving this particular update, the FCA has included a reminder of the key responsibilities of a principal that has appointed an appointed representative, and there are 5 key responsibilities. Firstly, fitness and propriety of the controllers, directors, partners, proprieties and managers of an appointed representative. Number 2, the solvency of the appointed representative and suitability to act for the firm. Number 3, adequate controls over the appointed representative's activities. Number 4, the appointment of the appointed representative must not prevent the firm from its compliance with the FCA's threshold conditions, and ability to monitor and enforce compliance with relevant requirements is number 5. So that's the position as regards the approved person regime for those who are still left in that regime. If we move on to the SMCR regime for solo-regulated firms, at the end of June, the FCA announced that Treasury had agreed to push back the 9th of December 2020 deadline for first round of fitness and propriety certifications to the end of March 2021. And this will give firms that have been badly affected by COVID-19 time to make the required changes. The FCA intends to consult on a similar extension to the date when the conduct rules apply to staff, and the date firms must submit information about directory persons to the register. And finally, references in its rules to deadlines for assessing certified persons as fit and proper. The FCA will be setting out further expectations around conduct rule training for staff. It has already made clear that the training that conduct rule staff will need to receive needs to be tailored. It needs to be a bespoke program, and the FCA is going to be setting out some more information about that. The FCA, notwithstanding the extension to the deadline, strongly encourages firms to certify staff earlier than March 2021 if firms are able to do so. And also notes that firms should not wait to remove staff who are not fit and proper from certified roles. The FCA will still publish details of certified employees of solo firms starting from the 9th of December 2020 on the Financial Services Register. And in fact, you may have heard that there's going to be a revamp of the Financial Services Register soon. Benchmark administrators have until December 2021 to train their non-senior manager staff on the conduct rules, i.e. there is no extension given to them on the basis that they should have enough time to be able to ensure that training is undertaken. So let's move on to another development, and in fact this is another speech which was made this time by Christopher Woolard, who is the interim chief executive of the FCA, and he was talking recently about investment managers at an investment association event. And so he spoke about the role of investment managers in the post-COVID-19 recovery. He explained that what the governments and the regulators have been trying to do during the period up until now is to build a bridge across the economic aspects of COVID-19 to ensure that as many consumers and firms can emerge in the best shape possible. The fund management industry demonstrated considerable resilience, he noted, against a background of market volatility. There is an ongoing issue, though, as you will be aware, with the suspension in daily dealing of open-ended property funds and the difficulty of how to ensure that open-ended funds that maintain a promise of daily liquidity to investors can do that when their assets are inherently illiquid. The FCA intends to consult later in the summer on some measures which will help firms to ensure those promises can be met. There is a very real challenge which arises out of the various governmental interventions, the various loan schemes, and this has been highlighted in a number of announcements and reports. But the City UK report is the one that Woolard referred to, and this talks about a recapitalisation somewhere in the region of £100 billion of investment being needed, which is clearly a very significant amount. The FCA seeks to understand whether there are some types of issuers that are unlikely to be served by public or private markets, and poses the question, is there a framework which accommodates a wide range of issuers and investors able to understand and bear risks involved? Clearly, fundamental protections for investors are essential, but the FCA recognises that it may be possible to calibrate the rules, and the post-COVID-19 situation will give rise to an opportunity to revisit the rulebook and focus less on tick box compliance and more on promoting outcomes that serve the public interest. We have obviously heard that refrain several times, so whether or not it will materialise, it remains to be seen. Finally, if we shift sectors to the payment and e-money sectors, and two main developments to mention, and I'll cover them quite quickly because we have referred to one of these already in one of our previous webinars. So first of all, the finalised guidance was published for the payment and e-money firm population regarding the coronavirus and safeguarding customers' funds. That was published on the 9th of July. The guidance clarifies how firms can comply with the regulations and help prevent harm to customers in an insolvency event during the COVID-19 crisis. There are a number of aspects which are addressed in the guidance. I'm not going to run through all of them, but safeguarding, prudential risk, and wind-down plans. The FCA hopes to conduct a full consultation later in the 2020-2021 period on its approach document, and it's likely that guidance on safeguarding and prudential risk management will be included in that updated approach document. At the same time as finalising its guidance, the FCA wrote to payment services firms and e-money issuers. It has already identified in its business plan that this area, risks to consumers in this area, is an FCA priority, and that supervisory focus and intervention is required. The letter sets out actions FCA expects payment services firms to take to prevent harm to customers. Again, this should be read alongside the guidance and the approach document. Firms have obligations under various pieces of regulation, namely the Payment Services Regulations 2017 and the Electronic Money Regulations 2011, as well as, since the beginning of August 2019, the Principles for Businesses section of the FCA handbook, which was extended to payment institutions and e-money institutions. The letter focuses on 6 key areas: safeguarding, prudential risk management, financial crime, financial promotions and consumer communications, governance and oversight, records management and reporting. CEOs should consider issues raised in the letter with their fellow directors, their board, and agree what further action is required. Principal firms should make sure their appointed agents comply with relevant sections of the letter. FCA emphasizes that it will take action where it identifies any weakness, and I think it's worth stressing that this is an area that we do expect there to be significant supervisory action and potentially enforcement action. Various issues in this industry have come to light recently, and I think it's reasonable to expect the FCA to want to take some significant action. Payment institutions and electronic money institutions, of course, should also factor in Brexit preparations. We have on our website some more detailed pages on COVID-19, so please, if you're looking to update yourself generally, take a look at those. We will now move on to climate financial risk.
Okay, thank you very much. Daniel said we're moving on to the Climate Financial Risk Forum Guide 2020. And this was published recently, 29th of June. The Climate Financial Risk Forum, which is referred to as the CFRF, published its guide, and the idea of that guide is to help financial services firms approach and address climate-related financial risk. The aim is to help firms understand risks and opportunities arising from climate change and provide support for how to integrate them into their risk strategy and decision-making processes. It considers how firms can plan for the impact of climate policies with different timeframes, and also to assess their exposure to climate-related financial risks so that they can adapt their businesses in response to those risks. There's several chapters there, and each chapter within the guide provides some examples and case studies which firms might find useful as they develop their strategies and their processes and approaches in relation to climate change. The PRA and the FCA have joined in with this. They've had discussions in conjunction with the CFRF, but it is emphasised that the views in the guide are not the views of the regulators, and it does not constitute regulatory guidance. So just have a quick look at the various chapters within the guide. So first one I will talk about is the one on risk management, and that covers risk governance, risk management, frameworks, risk appetite, risk assessment, data and tools, training and culture, and key challenges. There's quite a lot in there. And it looks at how firms can approach designing and implementing a governance approach for climate risks, similar to that's used for established financial risks, whilst also looking at specific climate risk-related matters. It discusses whether and how firms can decide whether to treat climate risk as a standalone risk or whether it's a risk that cuts across various sectors, and then to integrate that into existing risk management frameworks, recognizing how the links between climate risk and established risk types may be identified and understood. They say in that particular chapter, they say that in addition to the standard planning cycle, climate change impact should be considered over a longer period, for example, 30 years with interim milestones inserted. They provide detail on the most material and applicable risk types relating to climate across the financial sector, and those are insurance, underwriting, credit, operational and financial market risks. The chapter is designed to be read with the PRA's supervisory statement on enhancing banks and insurers' approaches to managing the financial risk from climate change, and also the FCA's requirements for solo regulated firms, which are discussed in the FCA's consultation paper that I'm referring to there. They also have a chapter on scenario analysis, and that outlines how to use scenario analysis to assess climate-related financial risks to inform the firm's strategy, risk management and business decisions. That's well illustrated with diagrams, that chapter, and it shows that it's expressed in diagrams showing that the results from identifying potential exposures should inform the development of scenarios, the process of developing scenarios, which will determine the key assumptions used in the assessment of the financial impact of the particular scenario. Information obtained from the financial impact analysis should in turn feed back into the refinement and the identification of new risks and potential exposures, and then should inform the ongoing development of existing scenarios, as well as leading to the identification of some new scenarios as well. The other important chapter there is on disclosures, and that covers key messages for approaching good practice climate-related financial disclosures, disclosures on governance and strategy, specific disclosures for banks, insurers and asset managers, and a suggested timeline for implementation. The recommendations are based on the 7 principles for effective climate-related financial disclosures, which are set out in those TCFD recommendations. And there's an appendix to that chapter with a table that summarises existing and prospective reporting requirements. Innovation is the final chapter there, and that explains how, by developing novel products, services, policies, approaches, a firm can adapt its business to respond to the potential impacts of climate change, how it can benefit consumers and deliver the change required to meet goals in relation to climate change. Various recommendations in this chapter in relation to innovation, developing new investment vehicles and products to enable the deployment of assets into various areas, building local partnerships between financial institutions, local authorities and other public sector bodies to support projects, and improving the quality and consistency of climate-related data to allow markets to identify risks and opportunities and then to be able to act on them effectively. So next steps, this is very much seen as a starting point, not an end destination. The CFRF is going to be building on the guide by developing new materials that progress the management of climate-related financial risks. It will continue to engage with firms on the issues they face and seek their views on areas where the recommendations could be developed further. The PRA and the FCA had a joint webinar on the 29th of June to launch the guide, and in that the PRA highlighted that it's going to be writing to firms, it says, in the coming days about climate change and its expectations. So we've got that to come quite soon. It also highlighted the work that's being done by the network of central banks and supervisors for greening the financial system. And it also highlighted the importance of the biannual exploratory scenario on climate-related risks, which has been postponed to summer next year because of COVID-19. So I will, a very quick run through there, I will pass on to Daniel for Prudential regulation of MiFID investment firms.
Thank you very much, Charlotte. So we are on the homeward straight, and we will cover the next 2 topics as quickly as we can. We begin with, I think probably one of the most exciting topics in this presentation, the Prudential regulation of MiFID investment firms. It is exciting because it really is a change in regime. The FCA published on the 23rd of June a discussion paper around the approach it will be taking to the Prudential requirements for MiFID investment firms to reflect the investment firm directive and investment firm regulation. So these were pieces of legislation that were on the horizon during the Brexit negotiation, but which now the UK is no longer required to implement. The UK will be changing the legislation or introducing new legislation as part of the Financial Services Bill to create a new framework for investment firms. But it's important to know that the UK was heavily involved in the evolution of the regime at the European level. And that probably explains why the FCA is very supportive of the intention of the regime, which it considers to be a bespoke regime for investment firms. So what are the key features of the new regime? Well, just to run through these quickly, the initial capital requirements that firms will be familiar with currently, well, they're going to be increased for the majority of firms, and we put those down on the slide. What counts as capital? There are going to be some changes there because the definitions will track some of the existing rules in the banking sector. But I suppose the key point to look at today is the minimum capital requirement. So the amount of capital the firm will be required, the permanent minimum requirement, the PMR, will be the same amount as it's required to have initially. But all firms now under the regime will be required to calculate a fixed overhead requirement. So broadly speaking, that's a quarter of fixed expenditure after deductions. Now, many firms, investment firms, will be already familiar with this, but not all have to do this. Some firms will have to calculate something called a K factor as well. More about that in a bit. So the minimum capital requirement will be the higher of the PMR and the FOR for some firms, but where the KFR applies, it will be the higher of PMR, FOR, and KFR. If you are following that, great. If not, don't worry. We will come back to this topic on another occasion and try and set out more details. So, other areas in which the regime will be changing, group risk, concentration risk, liquidity. This is a big thing to note. All firms will be required to have a basic liquidity requirement, individual investment firm requirements, regulatory reporting requirements, remuneration, public disclosure, and in time the disclosures that firms will need to make will include disclosures on ESG risks. We've set out in this table how firms will fit into the regime. Note that there are some very important, systemically important firms that will in fact be still within the CRR regime, and some who are sort of half and half, and then those then which fall within the IFR and the IFD. This flowchart shows you how to determine one of the very important concepts within the new regime, which is very important to try and work out what your capital requirement is, and that is whether or not you are an SNI. An SNI stands for Small and Non-Interconnected Investment Firm. You'll be pleased to know that I'm not going to go through each one of these questions, but these are the questions you will need to determine and answer in order to be able to determine if you are an SNI or not. And that is critical because that will determine what your capital requirement will be. K factors, these are new requirements, a new way of accounting for the potential harm an investment firm can do to its clients, the market in which it operates itself. They're based on the type and scale of investment firms' activities, and in fact you calculate all the various K factors that apply to you, and then you add those up and you get your KPR. The three categories relate to those areas: clients, markets, the firm. One example that we've given here is the K factor for asset management. So it's the amount of own funds investment firms are required to hold against risks associated with managing assets for clients. Exempt CAD firms. Now, there are those firms out there, some of you may be exempt CAD firms. You're authorized to provide only investment advice or reception and transmission of orders. You don't hold client money or securities. You're subject currently to a 50k euro capital requirement. Well, the capital requirement for those firms will change, and it will depend on whether you are one of these things, SNI or not. If you are not an SNI, then it's going to be the higher of 3 figures. If you are an SNI, then it will be the higher of your 75k or your fixed overheads requirements. The concept of Tier 3 capital will disappear, so short-term subordinated debt typically is Tier 3 capital. That will no longer be eligible capital. Remuneration requirements, they may apply. But importantly to note, there will be transitional relief. So if you're thinking, well, that capital increase is going to be significant for us, well, there is going to be transitional relief. It's not entirely clear how that's going to work out completely, but there is at least 5 years transitional relief for what's called the PMR requirement. So that would be limited to 2 times 50k for 5 years. There are quite a few open questions out there, and we strongly encourage you to engage with the consultation or the discussion paper. It is a significant change, but the FCA believes it's one that firms will welcome, and we set out the reasons there. Comments, as I say, on the discussion paper are really important. They're required by the 25th of September. The regime in Europe will kick in on the 26th of June 2021. There are considerable amounts of detail outstanding, but I think it's the broad expectation that the FCA will want the regime to apply here from the summer of 2021. Let's move on, finally, to artificial intelligence and machine learning. Charlotte.
Thank you. So, yes, we've got a robot hand there. This won't take very much longer. Unfortunately, we started late because of problems with the technology, and but we won't be more than a few minutes on finishing this. And this is a report by IOSCO, which came out in June 2020, and so IOSCO being, of course, the International Organization of Securities Commissions. And this report covers the use of artificial intelligence and machine learning, which is collectively referred to as AIML by market intermediaries and asset management. And they observe that artificial intelligence, machine learning, is increasingly being used by financial services firms, and that does in fact create significant efficiencies and benefits both for firms and investors, including increasing execution speed and also reducing the actual cost of investment services. However, using it may also create or may exacerbate certain risks which could potentially have an impact on the efficiency of financial markets, and that could result in harm to consumers. So, therefore, the use of controls surrounding AIML within financial markets is a key focus, a key priority for regulators across the world, across the globe. So they've identified certain risks in the consultation report. To do this, they surveyed and held round-table discussions with market intermediaries and conducted research with asset managers to identify how AIML is being used and the associated risks. They identified the risks that I've got on my slide there in the areas of governance and oversight, algorithm development, testing, ongoing monitoring, data quality and bias, transparency and explainability, outsourcing, and various ethical concerns. And As a result of identifying those risks, they proposed guidance to assist members in providing the appropriate regulatory frameworks to supervise market intermediaries and asset managers that utilise artificial intelligence and machine learning. The guidance consists of 6 measures that to assist IOSCO members in providing the appropriate regulatory frameworks for supervision. The guidance isn't binding, but people are encouraged to consider the proposals carefully and to adhere to them. And in addition, members of IOSCO and firms should also consider the proportionality of any response when considering the proposals. They also say that the use of artificial intelligence and machine learning will be likely to increase as the technology advances, and so it's likely that the regulatory framework will need to evolve in tandem with that to address the associated emerging risks. Therefore, they're going to be reviewing that and updating it as technology advances, so this won't be the final report we see on that. So here are the six measures. So the first one is in relation to senior management. Regulators should require firms to have designated senior management responsible for the oversight of development, testing, deployment, monitoring and controls of artificial intelligence and machine learning. And that includes requiring firms to have documented internal governance frameworks with clear lines of responsibility. There should also be an appropriate senior individual with the relevant skill set and knowledge to sign off on these various updates of this technology. In relation to the second measure, firms should be required by their regulators to adequately test and monitor the algorithms to validate the results of the techniques on a continuous basis. It should be conducted in an environment that's segregated from the live environment in order to be able to ensure that that the artificial intelligence and machine learning behaves as they would expect in all conditions and operates in a way that complies with regulatory obligations. Thirdly, firms should have the adequate skills, expertise and experience to be able to develop, test, deploy, monitor and oversee controls over the artificial intelligence and machine learning that is utilised by the firm. Compliance and risk management should be able to understand and challenge the things developed. They should also be able to challenge the level of knowledge, expertise and experience there. The fourth measure, firms should be required to understand their reliance and manage their relationship with third-party providers. And in relation to these third-party providers, they should be required to monitor their performance and conduct oversight of them. There should be clear service level agreements and contracts in place, setting out the scope of any outsourced functions and the responsibility of the service provider. There should be clear performance indicators, and there should be sanctions in there for poor performance as well. The fifth measure covers disclosure and the level of disclosure of the use of artificial intelligence and market learning, and that will include requiring firms to disclose meaningful information around the use of AI/ML that impact client outcomes and the type of information that firms may require. And the sixth and final measure is that firms should have appropriate controls in place to ensure that the data in relation to AI/ML is of sufficient quality to prevent bias and should be sufficiently broad to ensure that there's a well-founded application of AI/ML. So the responses, so that consultation is out at the moment, with responses required to the consultation by the 26th of October this year. And so that is the end of our That's the end of our webinar. We finished exactly within the hour, but with the 7-minute overrun because of starting late. So again, our apologies for that. Thank you very much for joining us for the webinar. As I say, don't forget to submit questions. If you would like to contact us later with questions not on the webinar, our email addresses and our pictures are there in the days when we were able to have haircuts, are there on the final slide. Thank you very much.
Thank you very much, everybody.